everyone, my name is Apalak. Welcome back to yet another episode of Tech This Week. So on today's episode, I will probably like to touch upon the recent tremors in the Edtech sector, most prominently by one of its biggest players, Byju. So as you all are aware, in the past few months, Byju has found itself in the news for all the wrong reasons. There were issues of financial discrepancy, layoffs, a business model which focused more on sales than actual learning outcomes, so on and so forth. But probably through the example of Byju, I'd like to discuss or put my focus on a larger aspect as to why do we have these bubbles in the market and why do they burst? And for retail investors or small-time investors like the common man, how can we safeguard ourselves from such eventualities? But before that, probably it's important once we understand this particular instance as to why this kind of happened, what has happened. So obviously, Edtech promised tremendous growth for a country like ours, right? So it was pretty much considered like the golden child in the startup ecosystem. And it promised to reduce or end the education gaps that are there in the market. And I guess it would not be wrong for me to say that COVID-19 kind of worked as the Midas touch. It worked as a catalyst. The world kind of, world, or at least India for the matter, because this Byju is a very India phenomenon. It would be wrong for me to call it a global phenomenon. But, so the COVID came in and it kind of set the stage for companies like Byju and its like to explode like there's no tomorrow, right? So fueled by investor money, the so-called latent demand in the market, and hyper marketing, many edtech companies sprinted to scale, and they gave us this impression that the demand would be perpetual. Yes, and I'll come to a very important element to this, and I'll bring the focus to that as to how we look at education as a sector, but more on that later. And like I said, thanks to COVID, the illusion became reality because these companies not just sold courses, they tried to get into, there was this sense at times that are these edtech companies going to run parallel education system in our country, right? But then things came back to normalcy, schools started reopening, the world came back to pre-pandemic norm, and the sector faced its first major test, which was sustainability beyond the crisis scenario. So the question that was in front of this particular sector was, can mere aggressive marketing and sales tactics, help prioritize growth over quality of education, And what we eventually clearly saw was these organizations set unrealistic expectations, not only for investors, but for users alike, right? So this overreach combined with eventual normalization of the market, as we call it, the post-pandemic scenario, left many edtech firms struggling to justify their valuations. So when you talk of valuation, a valuation of an organization is based on many conditions, but to probably oversimplify things, valuation is based on a particular promise that the company holds in terms of the products or services it delivers, that eventually money will be made, revenue will be realized for what the service it offers, right? But in history there have been many examples. Like if you go back right in the 18th century, there was this scenario of tulip flowers. The tulip flowers was in big demand, and then it collapsed. The market crashed. Very recently, we all know about how the .com bubble burst, right? So why does a market crash at times? The market bubbles occur when there is a sharp increase in the price of assets or sectors beyond their intrinsic value, driven by exuberant market behavior, right? So this happens because of excessive speculation, excessive optimism, misleading promises, mind you, and a bandwagon effect as well, right? So there's a reality disconnect as it grows wider. It sets the stage for an inevitable correction or crash. In fact, when I was doing my research around this, I came across a very interesting term. For people who invest in the stock market would probably know it. It's something called as the greater fool theory. It's a phenomenon whereby prices go up because people are able to sell overpriced securities to a greater fool, whether or not they are overvalued. So, but if you look at typically who takes what are the cost of such market crashes? Because people who are running such organizations, many a times we've seen in the past, go scot-free, right? They file for bankruptcy and they remain rich. The institutional investors, because they probably, because of the condition of nature of work being such, they also somehow manage to clear up. It's usually the small-time investor, the retail investor, which takes the biggest brunt of it. Now, coming to we have to understand one thing. Are we saying the education sector has collapsed? No. What we are in this entire story, what you need to understand is the Edtech sector has collapsed. So, wherein we're talking about any prefix which has tech in it. For instance, just as an Edtech, often acts as a magic wand, instantly elevating the sector or company to an unimaginable perceived value and appeal. However, the allure of this quote-unquote tech can also inflate valuations beyond reason, drawing investors into illusion of profitability. In fact, many organizations, paint an image that can be misleading as well. So volatilities in such markets often cushion the wealthy, like I said, leaving the smaller investors facing the market swing. So that is something we need to be careful. How do I mean, are there ways, are the checks and balances in place to see and avert such this situation? Probably they are. Probably we are not the right organization to deal with it, but this is just to give you an impression and an understanding. The irony of the situation. Education as a sector is not diminishing even by this door. In fact, it is still a extremely profitable and growing sector. It is an Edtech sector which is struggling. So if you look at it closely, contrary to the struggles with the Edtech sector, the traditional coaching market actually continues to thrive even to today. So this resilience underscores a very, very critical insight. The issue lies not in the demand for education, but with the delivery model of Edtech, right? So for instance, AR and VR may give you tremendous promise of immersive experiences, but do you think they'll be able to replace tourism? I guess not, right? So it's not always about the hype, but also about the value of the use case. I'll probably leave you with this. So, just to conclude, success in the business world, regardless of sector, is built on providing genuine value and sustainable growth, and is rooted in solid business fundamentals which stem from human requirements or business requirements and not fleeting hype. That's it from my end. Have a great weekend. Bye.